2026 is turning into one of those years that nobody really saw coming. For the longest time, crypto revolved around a single narrative. Bitcoin leads, everything else follows. That idea shaped cycles, sentiment, and capital flow for more than a decade. But now, cracks are starting to show in that belief, and the market is quietly shifting its attention elsewhere. Several analysts and industry voices are now openly questioning whether Bitcoin has already topped for this cycle. The argument isn't emotional, it's structural. According to these views, Bitcoin may have peaked months ago, and the next phase could involve another 20 to 30% downside before any meaningful recovery. Some even suggest there will be no new all-time highs in 2026. That alone is enough to make people uncomfortable, especially in a market that has been conditioned to expect Bitcoin to always bounce back stronger. But here's where things get interesting. While Bitcoin dominance looks shaky, the broader crypto ecosystem isn't slowing down at all. In fact, it's accelerating. The real story of 2026 isn't about digital gold or store, a value narratives and more. It's about utility. It's about real-world asset tokenization, cross-border payments, stablecoins, and infrastructure that actually moves money at scale. Institutions aren't just talking about blockchain now. They're building on it. They're deploying capital, launching products, testing settlement systems, and integrating blockchain rails directly into existing financial structures. Speed matters, scalability matters, regulatory compatibility matters, and those requirements are pushing institutions toward networks that were designed for throughput and compliance from day one. That's why assets tied to real-world use cases are beginning to diverge from Bitcoin's price behavior. Networks like the XRP ledger and similar ecosystems are increasingly being viewed through a different lens, not as speculative bets, but as financial plumbing, tools that enable value to move instantly, cheaply, and globally. This is where a major divide in outlook appears. Some analysts are still playing it safe, forecasting low double-digit gains for utility tokens at best, flat performance if conditions tighten, nothing explosive, just modest growth. But that conservative view doesn't sit well with everyone. The counterargument is simple but powerful. Trillions of dollars are preparing to move on-chain, not someday, not theoretically. Actively, regulatory clarity is improving. Frameworks are being drafted. Pilots are turning into production systems. And when traditional finance finally commits at scale, price action doesn't stay polite. It becomes aggressive. That disconnect between conservative forecasts and increasingly bullish institutional behavior is one of the most important tensions in the market right now. On one side, cautious analysts downplaying upside. On the other, banks, asset managers, and regulators quietly laying the groundwork for mass adoption. Regulation plays a central role in this shift. One of the most telling signals comes from former CFTC Commissioner Caroline Pham. Her involvement in tokenized collateral and stablecoin initiatives, alongside major players like Ripple, Circle, and Coinbase, sends a clear message. Traditional finance isn't fighting blockchain anymore. It's aligning with it. Tokenized treasury funds, non-cash collateral, stablecoin settlement layers. These aren't experiments for crypto natives. These are tools being designed for institutions that manage billions and trillions of dollars. When regulators who once oversaw the system begin working directly with blockchain infrastructure providers, it changes the entire conversation. Speculation around Ripple's strategic moves and partnerships only adds fuel to that narrative. Whether it's acquisitions, integrations, or ecosystem expansion, the company continues to position itself at the intersection of regulation and utility. That's not accidental, it's strategic. Geographically, Asia is emerging as a major growth engine in this story. Japan and South Korea, in particular, are becoming critical hubs for blockchain adoption. Regulatory clarity in these countries is advancing quickly, and developer activity is accelerating alongside it. XRP adoption in these regions isn't just theoretical. In South Korea, XRP has at times outpaced Bitcoin in trading volume, highlighting a very different market preference compared to the West. Japan, meanwhile, is methodically aligning its financial system to support tokenization, instant settlement, and blockchain-based financial products. Ripple's significant investment in these regions underscores how seriously this opportunity is being taken. Billions of dollars committed to expansion, developer grants, partnerships with banks, and experimentation with on-ledger lending and yield generation. The XRP ledger isn't just a payment rail anymore. It's evolving into a broader financial ecosystem. At the same time, attention has turned towards spot XRP ETF. For weeks, inflows were steady, even historic. Then suddenly, irregular activity disrupted the streak. A single player appeared to overallocate, then rapidly unwind the position, ending a long run of consistent inflows. That moment raised questions. Was it a mistake, a tactical move, something more calculated? Whatever the explanation, it highlighted how institutional behavior can influence short-term market dynamics. But importantly, it didn't shake the broader conviction around XRP long-term role. One day of turbulence doesn't negate years of infrastructure development. Another pivotal moment in the script comes from a broader debate about Bitcoin itself. Beyond being a store of value, what role does Bitcoin really play in the future financial system? Critics argue that Bitcoin's limited scalability makes it unsuitable as global financial infrastructure. 7 transactions per second simply doesn't support a world where billions of users expect instant settlement. Supporters counter with long-term narratives, digital gold comparisons, and historical performance. But the critique remains sharp. Even if Bitcoin succeeds as a vault of value, that doesn't automatically make it the foundation of the next financial system. That's where stablecoins and high-throughput networks enter the conversation. Stablecoins already move billions daily. They settle instantly. They integrate with existing systems. They don't require volatility tolerance. For institutions, that's far more compelling than speculative upside. High-performance networks capable of handling tokenization, lending, settlement, and interoperability are becoming the backbone of this new financial layer. Ethereum, Solana, XRP Ledger, Stellar, Chainlink, and others aren't competing to replace Bitcoin. They're building the rails Bitcoin was never designed to be, and that's the real takeaway. Crypto in 2026 is no longer about speculation. It's about infrastructure. It's about who is building systems that actually get used. Bitcoin may coexist as a digital vault, a macro hedge, a reserve asset, but the real innovation, the real growth, and the real capital deployment are happening elsewhere. Utility-driven networks are where financial institutions are placing their bets. Tokenization, instant settlement, cross-border liquidity, yield generation, and interoperability aren't buzzwords anymore. They're active projects with real users and real money behind them. The narrator remains firmly bullish on utility assets, confident that this shift is only beginning. The invitation is simple. Revisit these predictions in 6 months, in 12 months. See which vision of crypto's future plays out. Whether Bitcoin reclaims center stage or utility quietly takes over, the next phase of crypto history is already unfolding. And this time, it's being built, not hyped.